Hello friends, my name is Alok Bhanushali and today we are going to discuss about the redemption of preference shares. Redemption means repayment of preference share capital by the company. It takes place at a pre-decided time and price, means when we issue the preference shares, that time only we decide what will be the time and what will be the price of redemption. Redeemable preference shares are repaid after a fixed period. Redemption date is called a maturity date. Purpose of issuing redeemable preference shares. Company issue redeemable preference shares because it is easy method of raising finance. Second, it is attractive to investor due to assured repayment. Means when we issue preference shares, it is been assured that the repayment will be occur. Useful when shares are not easily marketable. No compulsory dividend during losses. It means when the company occurred losses, that time it is not necessary to pay them dividend unless it is a debentures. Can be redeemed when surplus funds are available. Now, what are the legal provision as per Companies Act while redemption of preference shares? So first point is no irredeemable preference shares. It means company which is limited by shares, they cannot issue irredeemable preference shares. Company has to issue only redeemable preference shares which can be redeemed after a specific period of time. Now, what will be the period of redemption? The preference share must be redeemed within 20 years. The maximum number of limitation is 20 years, and for the infrastructure company they can issue preference shares up to 30 years, means they have an extension of 10 years. Third condition is that the preference shares should be fully paid up. Partly paid preference shares cannot be redeemed. Now the source of redemption will be first out of divisible profit or out of proceeds of fresh issue of shares. So company has two sources from which they can redeem the preference shares. One is distributable profit that is available for the purpose of dividend, and second the proceeds of fresh issue of shares. Next, premium on redemption. Premium payable on redemption must be provided out of profit or out of security premium, but it is subject to condition. The condition is if the company is following section 133, that is accounting standards, they cannot use security premium for the adjustment of premium payable on redemption of preference shares. Profit include divisible profit and capital profits. Next is capital redemption reserve. It means when the redemption of preference shares is done through profits, so the nominal value of shares redeemed which is used by the profit, it should be transferred to CRR account. It means when company redeem the preference shares through profits, that much amount of profit is being transferred to a separate reserve account that is called capital redemption reserve, and that can be used only for issuing fully paid bonus shares. No other purpose can be fulfilled by these reserves. Only you have to use this CRR for issuing fully paid bonus shares. Now, special provisions for infrastructure project. It means if there is an infrastructure project, the company can redeem the preference shares for more than 20 years but not more than 30 years. But there is a condition. After 20 years, company has to redeem the preference shares in a proportionate basis. It means if company is redeeming the preference shares for next 10 years, company has to start their redemption minimum 10% from the 21st year onwards, and then in second year next 10%. This way they have to redeem the preference shares. Now redemption of unredeemable preference shares. If company want to issue new preference shares in behalf of old preference shares, company has to take the consent of 75% in value of preference shareholders and approval of NCLT, that is National Company Law Tribunal. It means they have to take the consent of 75% in value of preference shareholders and approval of NCLT. Next, restriction on security premium. Certain classes of companies cannot use security premiums for paying premium on redemption of preference shares or debentures. Revaluation reserve cannot be used for writing of premium on redemption. So we cannot use revaluation reserve also for writing of the premium. Inability to redeem preference shares. If company cannot redeem or pay dividend, company can issue further redeemable preference shares. It's like renewal of preference shares. Company will acquire your old preference shares and company will further issue you new preference shares which is redeemable, but it will be happen only when the 75% of preference shareholders in value give the consent as well as NCLT approval. So old preference shares are deemed to be redeemed on issue of new shares. Now what are the sources of redemption? So first source is proceeds of fresh issue of shares. Means company can freshly issue shares for the purpose of redemption. Now what is proceed does mean? Proceed does not means total cash received in all cases. For redemption of preference shares, security premium is excluded. So when the redemption of preference share is occurring, security premium should be excluded, and proceeds means only face value received or the net amount received in case of discount. So proceed does not mean total amount received, which is including premium. So this is the case. If the company issues shares at par, the proceeds will be face value of shares. When company issue the shares at premium, that time also company has to consider only face value, premium amount should be excluded. And when company issue this preference shares or new shares at discount, that should be happen through net amount received, that is face value minus discounted value. Important, security premium cannot be used for redemption. Proceeds of debentures also cannot be utilized for redemption. If we are issuing shares and if you are issuing debentures, only proceeds from shares is being considered for the redemption of preferences. Now next is profit otherwise available for dividend, that is called as divisible profit. So company can use their divisible profit for the purpose of redemption. If fresh shares are not issued, redemption must be done out of profit, which is available for dividend. When redemption is made out of profit, company has to transfer the required amount to separate reserve fund, that is called capital redemption reserve. Capital redemption reserve ensures capital is not reduced. Now key for distinction, divisible profit is used for CRR, non-divisible profit cannot be used for CRR, and premium on redemption may be paid out of security premium or capital profits. These are the list of divisible profits and non-divisible profits. Divisible profit which is available for dividend are profit and loss account, general reserves, dividend equalization reserve, insurance fund, workman compensation fund if the funds are free, debentures redemption reserves, reserve funds, investment fluctuation reserves. And in non-divisible profit, there is security premium, capital reserve, capital redemption reserve, which is existing in the nature, investment allowance reserves, development rebate reserve, profit prior to incorporation, share forfeiture account, and revaluation reserves. Now, important point is when there is an insurance or workman funds usable only to the extent of surplus. If there is any litigations in insurance and workman compensation, that reserves cannot be utilized for the purpose of redemption. Profit on sale of investment is a divisible profit. Revaluation reserve cannot be used. Thank you so much.